Good morning and welcome to this Monday, June 28th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we're off to a new week, getting ready to close out June. Kind of hard to believe, but we've got more jobs reports out this week. The ADP employment report will be out on Wednesday. We had a huge number last month, almost 1 million. Expecting a lot less this month. And then, of course, on Friday, we have non-farm payrolls, which, in my opinion, is much more closely watched. So we'll see how that comes out on Friday, but I would expect continuing improvement in the economy. I think that is something most analysts are continuing to look for as well. As far as the last week went, we continued to push higher in our major indices. The big news really last week was the breakout of the Nasdaq to an all-time high, and resumption of some strength, relative strength in both technology and consumer discretionary recently. So we'll take a look at some of that later in the show. Before I get into any of that, though, let me take you over to Earnings Beats for those of you who are new to us. Here at Earnings Beats, we do have a free newsletter, the Earnings Beats Digest, which is published 3 times a week, Mondays, Wednesdays, and Fridays. If you go over to earningsbeats.com, you'll see it here on the left-hand side of your screen. Just simply type in your name, email address, hit that subscribe button, and you will be set up. It's completely free, no credit card required. You can unsubscribe at any time. So check it out. We've got many, many thousands of folks that follow us through the Earnings Beats Digest. We'd love to have you join the community. We also do a lot of free events, and when we do, we reach out to our this community as well. So it's a good idea to be signed up. Let's take a look at what is going on, or what went on last week to close out the week. You can see the Dow Jones Industrial Average finished up 237 points on Friday, moved back above both of its moving averages. The S&P 500 up 14 points, or about 1/3 of 1%, closing at an all-time high again. The NASDAQ, this was the breakout right around the 14,200 level. We finished at 14,360. We were down 9 points on Friday. So Thursday was our closing high, which was up close to the 14,370 level. Mid caps, really strong week last week, getting back through the moving averages. That was pretty important, especially after this little false breakdown when we moved to about a 3-month low. The previous, I guess it was last Monday when we closed down there. But we did rebound very strongly last week, which was good. Small cap, same thing. Didn't quite break down below prior lows. We held those, but really nice move last week and nice reaction back to the upside. Looking at the sectors, financials finished the week strong, up more than 1%. Utilities also up more than 1%. I had been looking for 64 as support here, but similar to what we saw in the mid caps here with this false breakdown, it looks like maybe what we got with utilities on that move down to about a 3-month low before rallying on Friday up more than 1%. Staples had a pretty strong day, up about 3/4 of 1%, moving back to test their moving averages. Real estate up a little less, but still up close to 3/4 of 1%, and testing their rising 20-day moving average, bouncing off of it pretty nicely. The only group that finished down on Friday was really a group ready maybe to take a little bit of a pause, and that was technology. I don't know how much it will last. Futures on the NASDAQ are outperforming today. So I have a feeling we'll see technology strong again. But we did pull back just slightly on Friday, and that was the only group that was down on Friday. So technology taking a little bit of a pause. Moving on to the Treasury market. There's no economic reports out today. So this, Treasuries will pretty much just be trading on their own. We are currently down about 3 basis points, 1.51%. Whereas before we were trading in this 150 to 175 range off of an uptrend. Now we're actually downtrending below these moving averages, and I'm looking for maybe 140 to 160 being the range. So down 3 basis points today, still right in the middle of that short-term range. And the 140, I came up with 140 really from this gap area where the yield had gapped from 140 up to about 146. 147, and that's when it ran to 175. So I think any kind of a pullback into that 140 level, I would be looking for the yield to bounce, which in turn means that's where you would probably run into some sellers of treasuries, because treasuries and treasury yields always move inversely to one another, always 100% inverse. So anytime you see the yield moving up, it means folks are selling bonds. And when the yield's going down, it means folks are buying bonds. And that certainly can be a signal in the near term. I think the longer term or more intermediate term, I think you can see the yields going up, which means folks are getting out of bonds. And the reason you do that, normally one of two reasons, either because you're afraid of inflation or because the economy's heating up. And generally, you're going to do much better in stocks than you are in bonds when the economy's strengthening. I think the way other areas in the market are trading, I think it's pretty clear to me the market is not concerned, at least not right now. The market is not concerned with inflation. I think this has much more to do with economic growth and economic expansion ahead. And so I would be looking for rates just to simply move sideways here for a while. And we'll see what happens as we get through earnings season, not just with earnings season, because that tells us what happened last quarter. But I'm interested to listen to some of these companies as to what they see in the next 3 to 6 months. So watch for the guidance. That's going to be really important, especially as we move through the summer months, which can be somewhat challenging historically. All right, let's see. Let's move on to talking technically. And here what I wanted to do was just take a look at the sectors and how they're performing versus the S&P 500. So the top panel up here you see is the S&P 500, which we've seen has been going higher and higher. Then down below, we've got technology, consumer discretionary, communication services, financials, and industrials. And all of these panels down here are relative to the S&P 500. So this is not absolute performance of these 5 sectors. This is relative performance. So many of the groups have been going up, but their relative strength has been going down. And that's fine. I mean, even throughout, this time period here, we weren't really seeing a lot of selling in consumer discretionary. It was just that it wasn't participating with the S&P 500, and it was going down on a relative basis. But that started to change. And this is the part that makes me a little bit more excited in the near term, is that we've got probably one of the strongest up moves in relative strength with technology since all the way back at the end, well, really the end of summer last year, heading into the beginning of September. If you recall, that was a pretty big top in not just technology, but the overall market. Many of the growth stocks back in September of last year, things started to shift. But that was the last time we saw a really strong up move in relative strength. And you can see we're getting that now. I'm watching this relative high right here on technology, which we hit in April. I think if we can clear that, I think we're going back to the highs. So I would watch that level very closely. Consumer discretionary, maybe not quite as strong as technology. Certainly we haven't been strengthening for as long, but we are coming off bottom. And this is the time of the year where typically we do see technology and consumer discretionary lead heading toward earnings season. This is something that's been going on for many, many quarters, many, many years, many, many decades. So nothing new here. Yeah, I would expect it, unless I'm proven wrong, I would expect technology and consumer discretionary to lead. Now you look at this chart and you say, well, the S&P 500 has been going up and I'm not really seeing a lot of strength here. Well, if we stretch this out, because you have to give the market time to consolidate, just like an individual stock. When a stock's going up and up and up, and then it consolidates for several months, it doesn't mean that the stock isn't going higher or that things are horrible within that company. Companies need consolidation. Same thing with these relative strength charts. You need to consolidate from time to time. So I'm going to stretch this out five years weekly. And now I think you see a little different picture. Technology, huge leadership. And then we just simply been consolidating since that September high. Consumer discretionary, same thing. We had a huge run up last year. That's what we forget sometimes when we get into the moment, the near term, and you just look at consumer discretionary and think, what's wrong with consumer discretionary? Nothing's wrong with consumer discretionary. It absolutely crushed the S&P 500 last year coming out of the pandemic. So as money rotated and went over to the more, more of the reopening and the value stocks, consumer discretionary and technology took a back seat. Didn't go away, just took a back seat. I think they're starting to come back out now, and I wouldn't be surprised to see a big move to the upside in terms of relative strength in both of these groups. So these are two areas that I'm watching and trading as we head toward earnings season. Communication services has been strong all along. Really throughout the pandemic, we continue to do well. I think internet stocks setting new all-time highs. So this is an area of the market's been doing very well. We move on to financials and industrials. These two groups were not doing well heading into the pandemic and the early stages of the pandemic. But since then, we've seen both come back. And financials in particular, off of that low in November, have been benefiting from the move in the 10-year Treasury yield. I mean, look at this was November. This is when the positive news came out on the vaccine, and you can see the move in the 10-year Treasury yield. That is generally going to help financials, and that's just when we got going in the financial area. The recent pullback in yields, you can see financials started to struggle again. I don't think yields go down, though. I just don't. I think the economy is going to be too strong. I really don't think yields go down. The question, I still think that the overall trend is going to be a little bit higher down the road, maybe later in 2021 or into 2022. I think we'll see the yield moving up over 2%. And so I think that's going to continue to bode well for financials. And you might say, well, higher interest rates are going to be bad for growth stocks. I don't think so. I mean, you're going to go through periods where they consolidate and pull back, just like we saw here recently. Software stocks, semiconductors kind of paused for a while. They're starting to get their legs under them again. There's nothing wrong with growth stocks in an environment where you can expect 6-7% GDP growth and a 10-year Treasury yield currently sitting under right about 1.5%. That's nirvana for growth stocks. 2%. I mean, look at a long-term 10-year Treasury yield. I mean, going back 60, 70 years. This 1.5%, this is crazy low. 2% would be crazy low from a historical perspective. So I wouldn't get all caught up in interest rates going up. Just look at the absolute rate, the 2%. If GDP is 6%, 7%, and we've got interest rates at 2%, I'll take my chances with growth stocks. All right, let's keep moving on here. This is another chart of the S&P, but down the bottom here, we've got consumer staples and healthcare and real estate going up. Real estate's the only one that's been going up, and utilities. So when you look at this and you think, well, some of the aggressive areas of the market have underperformed, it's not because the defensive areas have outperformed, with one exception. Real estate's been doing really well, but the others are pretty close to or at 52-week relative lows. The real difference in the market right now, in my opinion, is that the dollar had been so weak that energy and materials had been performing well, and that takes away from technology and consumer discretionary. So if technology and consumer discretionary went down for months and months, and we saw all of these defensive groups outperforming, that would make me more nervous about the market. That's not what we're seeing. We're in the, heading into the worst part of the year, summertime, and consumer staples and utilities both are down at 52-week relative lows. That's good news. The professionals on Wall Street are not moving into defensive areas, with one exception, real estate. I think 3 of the 4 groups, and even healthcare, I don't really look at healthcare as nearly as defensive as the others. Pharmas are defensive, but I look at some of the healthcare areas, especially biotechs, as being very aggressive. So anyhow, I just wanted to go through these sectors because, in my opinion, I think the market still sets up very well for continuing move to the upside. I look at relative strength of sectors to try to evaluate the sustainability of the S&P 500's move. I think if you study history and you go back and you look at key market tops, you'll see a tremendous shift in relative strength in these various areas that I've just discussed prior to the overall market starting to move lower. So what happens is as you start to near tops, you get money that rotates heavily into defensive areas, and you start seeing some of the more aggressive areas falling apart. And I just don't see that right now on these charts. So I believe the bull market is perfectly intact, is sustainable, will continue to move higher. Does that mean that we cannot possibly have a 10% correction over the summer? No, I'm not saying that. Anything's possible. There could be a news story, and we know how. Again, this is just my opinion, but the media is going to run with anything that they can run with that's negative, because negative news sells. I'm not trying to bash the media in the sense that they are deliberately trying to get people to sell. I don't think that's what's going on. I think they are trying to get clicks on their headlines. And the way you do that is to paint horrible pictures. And so, yeah, if we start having, let's say we get more inflation reports that come out and the media really starts beating on inflation again, yeah, we could have a 10% correction. I wouldn't rule it out. I don't think we're going to have one, but I wouldn't rule it out. And it wouldn't change my long-term call in the market. You're going to have corrections from time to time. Everybody sees a correction, they immediately want to go to, Great Depression 2.0. 1960s, we were in a secular bull market. We had 4 recessions. 4 different times we had the stock market drop 20% or more during a 10-year, well, it was 20-year, it was 1950s and 1960s. But the 1960s were a much more volatile period, even though we were in a secular bull market. So anything's possible. We've been in a secular bull market. I've been writing about this for years. We've gone through the trade war. We had a 20% drop, fourth quarter of 2018. And then the pandemic, we had a 35% drop in the S&P 500 in a month. But it was all part of a secular bull market, which is long-term bull market. Short-term cyclical bear market within a long-term secular bull market. Very important to understand the big picture. It's almost like, looking at the ocean or something, you see the waves coming in, but a lot of times the tide is going out, even though the waves are coming in. You got to understand that big picture of what's going on in the market. Very similar. All right, let's talk a little bit about transports, because transports have not really been performing well. And transports are a sign of the economy. I mean, we want to make sure that transports are doing well. And so when I look at this chart, if somebody said to me, well, what's one thing technically that bothers you right now? I would look at this chart and I would say, I don't like what transports are doing in the short term. But longer term, I'll show you a weekly chart in a minute. I don't think there's anything wrong here. Short term, I think what's happening is we had a huge run up. I think we've pulled back. This could turn out to be a kind of a weird looking cup. Maybe we just kind of go sideways for a while, get into some rectangular consolidation. I don't know. I don't think we continue to go down though. And I'll show you in a second on a weekly chart why, but let's move on to the railroads. So we'll break down the transports. Here are your railroads, same type of a situation. You can see a low, there's a lower high, another lower low. We're bouncing back up, but we're struggling. PPO in negative territory. So again, on a daily chart, not looking very good, right? Then we go into the truckers. Look at this, same thing. Topping on May the 10th, lower lows, lower highs, failing at the 20. PPO negative, not looking good. And then we got the airlines. Airlines moving down, trying to hold on to this 220 support area. But also they actually topped back in March, had a double top. And so really don't want to see a big breakdown below 220. That could measure back down to about 190 or so based on this 30-point range that we've been in. So this is an area within transports that I think remains challenged, but this one's at support and really needs to hold in the near term. Now, I'm going to go back to that railroad chart first and just point out a couple of things. First of all, when we made the big run and we broke out back in March. We broke out from where? This level right here. That was the high back in January. We consolidated, had a little bit of an ascending triangle, broke out, measurement 3150 down to about 2800. That's 350 points. So you add 350 points on to 3100 or 3150 and you get 3500. Look at where we topped, 3500. And now we've pulled back almost to the point of the breakout level. So that would be the first thing. We're starting to see that PPO turn back up. If we do have a little bit more weakness in railroads, I think that's probably going to be it. I think anything back down close to 3150. I don't know that we go down to 3150, but if we did, I think that would probably do it for railroads. I'd be surprised if we go much lower than that. But I don't think we're going to go lower. And the reason is looking at the weekly chart. When I look at the weekly chart, what I see is a test of that rising 20-week moving average, which we have seen multiple times over the last year. And that has been where the buying has kicked back in. Notice we reversed higher. We finished higher than we opened last week. Opened below the 20-week moving average, climbed back above. Now you might say, well, yeah, but we got this divergence turning back down. Well, it's been, I mean, look at where we were when we broke out in March. When we broke out in March, we had a nasty divergence on this and continued moving higher for the next couple of months. Divergences are secondary to price action. You know, divergences are important. Trust me, I follow divergences, but you got to be careful about looking and seeing a divergence and then having that dictate everything else. To me, I wait for price action to confirm what I've seen in terms of some of those warning signs with divergences. Because when we broke out here in November, right here, we had a negative divergence. Rolled back over a little bit. We broke out again. I don't know if we had a negative divergence, but we certainly weren't going any higher. And then we broke out again. And once again, I mean, there's 6 months where we kept going higher. And then we tacked on another 2 or 3 months, all while we had a negative divergence. So sometimes, and if you got out on this first negative divergence here at 2850, here we are at 3,200 and you're still waiting to get back in. So you got to be careful reacting solely to a negative divergence. It's a great sign. Trust me, I do believe that you have riskier, you have to be looking at the market as being a little riskier anytime you see a negative divergence, but don't think it's a guarantee that prices are coming down. I think you need to see other corroborating evidence. All right, so here's your railroads on the weekly chart. Let's take a look at the truckers on this same weekly chart. And what I see there is a piercing candle, which is a reversing candle right at the 20-day moving average. See what happened the last time we went back down below the 20-week? See that reversing candle? Look what happened afterwards. Then we pull back, get that reversing candle. I wouldn't be surprised if we take right back off to the upside in the truckers. And then we get the airlines. And airlines, you can see why this 220 level is pretty big. We're also below the 20-week moving average. And you can see right around that 20-week or just below that 20-week is when we've regained our composure in the airline area. And here we are again. So all three areas on the weekly chart, I think, look like they should bounce or have begun to bounce. And that's why when I pull up transports, and transports are always important, but you look at the weekly chart here on the transports, and I think it's pretty clear that 20-week moving average has been critical. And here we are again, right at that 20-week trying to bounce. So I would expect it to bounce until the market tells me otherwise. So I think transports are going to perk up. I mean, we may hang around this 20-week moving average, maybe for a few days, maybe even for another week or two. But I think we're going to move higher, and I think it probably is sooner rather than later, especially with earnings coming up around the corner. All right, so those, I just wanted to go through those charts with you. One other thing I was going to do is just show you a scan. So one of the scans that we have over at Earnings Beats for our members is what we call downtrend reversal scan, where stocks put in lower daily highs for 5 consecutive days. And then we have a higher daily high. And so that can signal the end of a downtrend. Doesn't have to, but it just alerts us to any stocks on whatever chart list we scan against. It can tell us which of our stocks are performing well and which ones aren't, and which ones, look like they're reversing, and we can look for other supporting levels, or other corroborating technical evidence to help support maybe going long on that reversal. So I'm going to edit the scan so you can just kind of see what this is currently set up against these chart lists, but I've just changed all the chart lists, so I want to make sure that this is set up properly. So let me go in here and we'll just run it against the strong earnings chart list. So I'm just going to run this scan, which is looking for stocks that have gone down and put in lower daily highs for 5 straight days. And then the last day, whatever day it would be yesterday, reversed. Now, sometimes there aren't any, and other times there are lots of them. We just have to see. So I'm going to run this scan. Well, actually, first I'm going to save the scan. All right, so now if I come back and run it again, until I change my strong earnings chart list, I should be good to go. But I'm going to run this scan, and there were 5. So these are 5 stocks that are on our strong earnings chart list. That means in the last quarter, they beat Wall Street's estimate as to both revenues and earnings per share. So we know that they've got strong fundamentals in the prior quarter. And now we're going to be able to take a look technically to see whether or not we like them. Now, as you look across here, you can see the areas: utilities, materials, consumer staples, healthcare, and utilities again. So I'm not really a big fan of utilities. I'm not really trading defensive areas. Not a huge fan of materials just because I think the dollar is going to strengthen. But I'll take a look at the materials in the healthcare stock, and let's just see what they look like. So I'm going to shorten this chart so we can get a really good look. I'm just going to do 3 months. So you can see what the scan is picking up. Now, this one actually looks like from here down to here, 1, 2, 3, 4, 5, 6, 7 straight days, we had lower highs. And then on Friday, we started to tick back up with heavy volume. So if this was in a different area of the market, again, I'm not a huge material fan, so I probably wouldn't trade this one. But if this was in software or something like that, I would be much more interested, or any of the retail stocks. I think some of the retail is starting to pick back up again. That would really interest me. But here you can see it does look like it's starting to turn back to the upside. And, what's to say it's not going to put in a cup, get all the way back up to that 2470 area. So it's just alerting us to stocks that could, be in a position where you might want to be long. Now, the other one was in medical supplies, healthcare. So let's take a look at Sientra and see what's going on here. Well, this one had a huge move back in February. He's been sideways consolidating. He started to make a move with pretty good volume and then pulled back with lesser volume. And you can see the volume picked up on Friday as it broke that series of lower highs. So this one actually is starting to look a little bit better to me. It's a smaller company, probably isn't for everyone. The AD line's not strong at all. So I'd feel better if, that was starting to move higher as well. So I'm not really seeing a lot of, confirming evidence. I'm going to stretch this out to a weekly chart. Well, weekly, we're holding above that 20-week stock, coming off of that low all the way back a little over a year ago, off the pandemic low. Huge move to the upside. We got really nice. I'll tell you what, a breakout above $10 eventually would be very strong, but we're sitting back here at 7 and change right now, 728. But I do like the way the weekly is setting up. I think the daily is okay. I think this is one that I would be interested in, taking a look at. All right, what else do we have here? Let's go into not really anything with earnings. So I'm just going to go into the 3 you must see and wrap things up here. First stock is L Brands. Just broke out again above this double top. So I think this one looks good. Volume picked up on Friday. This is in the apparel retail area, which I do like. AD line setting new highs. That's strong. If it did pull back, I would certainly look for a bounce off the 20-day moving average. So I think LB looks pretty good. Let's see, what else did we have? How about Estee Lauder, EL? So EL is moving up. Now this one, you can see the AD line's been moving down, but here we are trying to make this breakout above this prior high. This is going to be a tough area. Above 320 would be bullish, but if we can't get through 320, I think a pullback into this range somewhere would be more appropriate. I like the stock. I think this uptrend is going to resolve in a breakout, but I don't know if we're going to consolidate further or not. Let's see if we can get through 320. And then the last one, market just opened. The last one is Macy's, ticker symbol M. Another very strong chart after a huge move up after the reopening trade. We went sideways. We got equal highs coming across rising lows. I believe eventually we're going to break out above this 21, 22 area. But you can see the tail on Thursday of last week failing at that 20 area. Maybe we pull back. I like it on the 20-day, which is down at 1873. So we'll have to see if that holds. Let's get a quick look at what's going on in the market, then we'll wrap things up. Well, hopefully we get a update here. No, maybe not. Let's try one of these others. Nope, I'm not getting it. Maybe I can get it on my other computer. Bear with me 1 second. Nope, I am not getting it. Well, it looks like I just went to a different website. I don't know what's going on. Maybe, I don't know if it's my internet slow or if stock charts having a little issue there, but I'm looking over, it's CNBC, and NASDAQ right now currently is up 83. S&P's up 6 and the Dow's down 25. So it looks like we're off to a pretty decent start. We'll see whether or not that rotation into technology and consumer discretionary, I'll be watching to see if that gains steam, because we do have earnings coming up literally in about 3 weeks. And this is the time right about now when we start to see a really big push toward earnings season. So that's it for me today. Everybody have a great day. Tomorrow I'll be back over at Stock Charts TV for your next episode of Trading Places Live. That will begin at 9 a.m. Eastern. Hope you can join me over there. In the meantime, have a great day, everybody. Happy trading.